Hey, hello, folks. Welcome to Pro Trader Strategies. This is my options guide. We're going to be cracking the code to trading options. In that, what we're going to do is build from simple concepts to real life examples. And at the end of it, we'll even throw in some trades that we could implement around all of the ancillaries that we find in the markets. All right. So we are going to be doing our options guide here. This is cracking the code to trading options. In this particular video, we're actually going to be doing it on the Iron Condor. All right. So the Iron Condor, very similar to the Iron Butterfly, which is what we did last week. Iron Butterfly is off of the straddle. I'm going to talk about that one even at the very end. We'll go back and talk about that strategy and how it looks today versus last week. I'll try and do the similar with what we're doing here in the Iron Condor. The Iron Condor is a market neutral strategy. It is defined risk, so we know what we're getting ourselves into before we even implement this strategy. I'll talk about how we find those strike locations, what kind of credit we're going to want to take for this strategy. All right. So I have specific rules around that so you guys can take some of that guesswork out of it. I find that if people are guessing on strikes, what their credit should be, all of those things makes people really just kind of bail out of these strategies too early because they aren't confident. What I'm going to do is I'm going to show you the probabilities with this strategy, why we're collecting that type of credit, and then ultimately how we would get out of this strategy if it's working or even if it's not. So like I said, I'm going to build from simple concepts. This might not seem so simple, but it's data transfers, just O's and ones, O1, just lined up differently. And what it does is it transfers all our data across the internet. So this is the most streamlined way to transfer data, but it can be intimidating when you're trying to look at it. So let's try and make it a little bit more simple by freeze framing this, peel back this onion to really see how these O's and ones lined up. You can see that there's different layers as well. I'm going to try and do this same idea with options. We'll build, we'll freeze frame it, we'll peel back that onion. And by the end of it, I think you guys are going to have a really good concept as to how these options prices are fluctuating and when, where, and why we can take advantage of that. All right. But first, what is the best investment one can make, right? When we're talking about investments here today, the best investment one can make. Guys, you can throw your comments over there in the comment section. We are on both Facebook and YouTube. I know sometimes it's difficult to comment on one platform or the other, but we are streaming on both of those. So please pick your poison so that you guys can comment because you guys drive a lot of this content. All right. So what's the best investment one can make? Has anybody ever heard the best investment one can make is a house? Throw a Y over there in the chat window if you have, because that's what I often hear. When I'm talking to investment professionals, I go to seminars and things like that. This is always the quintessential example of the best investment one can make. As a matter of fact, Rockefeller talked about it. Dirt was the best investment. Why? Because they aren't making any more of it. When he was referring to dirt, he meant the land that you would buy, because the globe is only so big, right? And it's not getting bigger, so that surface area is all there is to buy. So when we're talking about supply and demand, that's one of those aspects. Rockefeller knew that there was a supply issue on land. Demand was going to keep coming because we keep reproducing, right? So as we keep reproducing and growing as a global people, if you will, we all need a place to stay. So we are taking up more and more real estate per person, right? So one person back in the day used to probably take up a couple of acres. Now we're taking up a couple of feet, I guess is better, taking up less real estate, but wanting more, which is finite. That price should go higher, right? So when folks are talking about buy a house because that's the best investment you can make, well, we have seen time and time again throughout history, even just the last 20 years, prices of the housing market fluctuating, right? We've seen little dips and valleys in the stock market or in the housing market. We could go back to say like 2000. We got a little bit of a dip there. We got another big dip right around 2008, 2009-ish area. Got a rally. We even got a bit of a dip, I would say, right around the pandemic. So let's just say this is C19. We got a bit of a dip. Not really so much of a dip there afterwards, but this is what I would be looking for as the here and now. Are we going to go higher or are we going to go lower, right? We have recovered from COVID-19, but one of the things is if folks are telling you to buy a house because it's the best investment, doesn't it really still depend on your timing, right? So if we bought a COVID-19, yeah, well, you might have panicked a little bit. And would that have been buying low, selling high? Probably not. And that's the other thing you always hear. That's all you got to do is buy low, sell high. But when we don't know what's happening out here and we are here at the here and now, what do we think is low or high? Well, it's really going to be dependent on who we talk to. One thing I say as what we hear as bond prices start going down. So what we're seeing right now is hearing bond prices are going down, right? Because the Fed has stopped supporting it. So the bond prices are going down. Well, it's a teeter-totter effect. Interest rates go higher. And if interest rates are going higher, or the expectations of future interest rates moving higher, then that's where we see the disconnect happening. Because in order to have pricing go higher, we need to have the money in our pockets to be able to do that. Most folks in America live on a budget. Yeah, spoiler alert. So when we're talking about you and I, think about it. Your budget, you have your budget, might be bigger than mine. I don't know. So we all have our own budget, right? Where we believe that we are going to have the steady income month over month of X. All right. Now, if I have X month over month, I would say that most financial folks would say, and I'm not an investment professional for you guys, I'm not a fiduciary, so please don't take this as fiduciary investment advice. I'm just shooting from the hip here. But what would I say is most investment professionals would relay is about 25% of your monthly income can be allocated to buying a house, right? Well, that number is finite. And if interest rates are rising, part of when we buy a house, part of that house goes to principal, right? What the value of the house is, but part of it is going to interest as well. So part of it we're paying off the principal, part of it we have to pay off the interest on this balance. And if interest rates are, 5-6%, well, that is what we have to allocate on our budget to the interest, which means that we cannot pay as much towards the house. All right. And if we can't pay as much towards that house, well, then we can't afford that as much of a house, right? So we might start looking at smaller houses, and then the demand for those bigger houses starts going down. Well, prices have to pull back again. Okay. This is in theory, right? We've seen it happen time and time again. When the interest rates rise and we have finite amount of money, we can only allocate so much to or out of our budget to our house. Okay. Does that make sense for everybody? So right now we're at an influx. Are we going to move higher, or is this interest rate inflation thing going to drive prices lower because the interest rates keep jacking higher, right? And as they continue to ratchet up, more and more money goes towards interest as opposed to principal. All right. So we don't always know if our timing is right. And it's always such a novel idea when people throw that out there. I mean, you probably heard it if you watch TV on CNBC or Bloomberg or anywhere, you probably heard that at least once today: buy low, sell high, especially in pullbacks. That's so easy to say, right? But you never know how far it's going to pull back. But what we want to do is trying to find some things that will give us a bit of a clue as to whether or not they are expensive or cheap. And we do that by using charts, right? In a bullish move, we might see the support and resistance, and say, all right, we can find our buy and sell zones, right? You would be selling up here and buying down here. when it reaches those support levels. Oops, sorry, don't know how to spell buy all of a sudden. Or on a negative move, right? We can check out the patterns and try and draw some lines in there for some support and resistance, and the sell zone again on the upper band and the buy zone on the lower band. Now, bullish and bearish patterns does take a little bit more of a trained eye, if you will, to see some of those support and resistances. But just like when we talk about things like this, right? Those could just be two circles, but all of a sudden it looks like a face, because our brains are geared towards seeing things like faces in different objects, whether it's the clouds or a piece of toast. All right. We are looking for faces, and we are also looking for patterns. It's, like I said, a little bit more difficult to see the bullish and bearish patterns, but when we have them lined up horizontally, all of a sudden our eye has a tendency to be able to see those a little bit better. So when looking, or newer traders, I would suggest looking for markets like this that trade sideways, have a neutral bias, if you will. IBM's a great one. Kroger's another one. Kellogg might be, but some of those consumer staples usually have a pretty much sideways trending market. IBM is one of the quintessential best sideways trading markets. As a matter of fact, I've been trading IBM since college, and it really hasn't gotten very far away from 100. All right. Since the 90s. Yes, I'm dating myself, 30 years. It hasn't really gone anywhere. So sideways trending markets, finding those support and resistances is a little bit easier. So when we're looking at charts, try and draw these in there. And you guys probably have more education in charting than I do at this point in your lives. And you might have only been trading for a few years. I don't know. So what we try to do is see when the market hits these resistance areas, and that's where we would want to take on a contrarian, if you will, point of view, where it comes up, hits that. Some people are going to be bullish, but we see that support and resistance and take advantage of it. So while people are saying you always just buy low and sell high, that seems easy when you see the entire chart. That would have been the best way to take advantage, or you just buy it way down here again. But what happens, generally speaking, when we're trading is we don't have the opportunity to get in on that first buy there, right? We just have what we've seen before. We don't necessarily know what is happening all out in time there. So what ends up happening a lot of times is we end up buying here and thinking we're a genius. Don't sell. No, I'm not going to sell. And it comes right back down, right? You dump out thinking you just missed that opportunity. All right. Buy low, sell high. Not always the way it works out, even when we're looking at charts. Even if you bought here thinking you got the pullback, I didn't do anything, pulls back, buy. You think you're getting onto a good trade, and then all of a sudden it free falls. So we don't want to get caught buying up here, right? You don't buy up here. That's not what chartists do, all right? We would look to buy when we come down to the support area, all right? So if all stocks traded sideways, we'd probably all do very well trading these swings, right? But we don't often have what is going on, in time. Usually this is where we're at. It's an impasse. I would not be buying right now, just hoping that it's going to come up here to hit that top. It's way above that midline. So I would not be buying above that midline in this case, because it could easily just turn back around. So when we're looking at charting and trying to discern whether something is expensive or cheap, we often go to looking at the charts because it's difficult to say what this is worth. This is a golf marker, right, for your ball. Now, to me, this is actually, almost invaluable in a sense. To somebody else, it's not even worth $1, right? This pen, to me, is probably worth $100. To you, it's not worth anything because it does not work on your screen when it works on mine. So it will only work on my screen. So it's probably not worth anything to anyone else at all, for that matter. But when we're looking at stocks, we also can look at some other things, especially when we're trading options, because options, how do you know if they're expensive or cheap? Does anybody know if they're expensive or cheap in the options? I think I do. And I think that's what it's going to help you out when we crack this code. So options give us a tell when they are expensive or when they're cheap, because volatility, and in more particular, implied volatility. I'm not talking VIX. I'm talking implied volatility. All right. So if you ever hear me talking about volatility, that's the only volatility I really care about. The VIX, yeah, it sounds pretty good. The VIX, it's a volatility gauge. But what the VIX does, or the VIXX, is just a gauge of the entire market's volatility. So while it gives you a gauge over the entire market, it doesn't tell us whether this specific underlying, whether it's IBM or Apple, has high implied volatility right now. Because volatility is the key. Volatility is the key to determining the price of the options, right? There's a lot of things that can make them fluctuate the pricing at any given time, and most people will talk about those other Greeks, if you will. But I want to talk about implied volatility, because when we're trading stocks, we can chart implied volatility. So when implied volatility is down here at these low levels, then we know that the options are cheap, okay? So whether you come up with your directional assumptions, bullish, bearish, market neutral, we're not even concerned about that. I'm not even talking about a specific stock at this point, right? Because the specific stock doesn't really matter, other than we are trying to determine what the pricing is, right? The stock could be really expensive or cheap. I don't know. There's multiples on stocks. It's based on today's earnings, and then we throw a multiple based on how good the economy is going to do. Well, when the economy is doing bad, like right now, people pull back those multiple predictions. And then that's why the price is going down, because Apple's not likely to be a 20 multiple now. It's more likely to be a 12 multiple. So now they do the multiple on their earnings, and that's where they come up with their pricing. That's not what I'm talking about. If you have a bullish or bearish assumption, what we need to do is look at the options to see if those prices are cheap or expensive, and that will tell us what type of strategy, all right? Whether if you're bullish, say Apple, we look at volatility to see if we're buying calls because volatility is really low, or selling puts because volatility is really high. That's the best way to buy low and sell high, as far as I'm concerned, is when you're looking at options. That's the only real way. And that's because each individual underlying, if it's, let's just say it's XYZ right now, XYZ's implied volatility looks like this chart. It's sideways trending. It has a range, a defined, it's not defined, but it has a range that is pretty solid, because we can go back in time and see that these ranges hold true for the last several years. Yes, sometimes it will break through. That doesn't bother me that much. What I want to do is try and capture as many times as it gets up there to that expensive level, so that I can sell those options when they are expensive. All right. My directional assumption doesn't matter. All right. I'm just talking about the strategy I would pick with volatility really high is to sell or collect a credit. All right. When volatility is extremely low, then we want to pay a debit. Yes, we are willing to pay a debit when it's super cheap. Because volatility tells us there's a few rules with options. All right. One main one is options are based on an advancement, whether it's a dollar move higher, a day goes by, volatility increases by 1 percentage point. All right. $1, 1 day, 1 percentage point. Pretty easy. So volatilities is 1 percentage point increase, and all of the premiums in the options increase. Just like when 1 day goes by, all of the options, due to that theta decay, decrease in value. Now, one of the hanging chads is delta. Delta fluctuates with the underlying. We'll get into that. I'll drill down on that one here in a little bit. But right now, I want to concentrate on volatility and how it affects options premium. We know 1 percentage point higher, those all increase. A negative, meaning they move down a percentage point, a negative plus a positive makes it a negative to the position. All right. So if we want volatility to come down, we need to do it when it's pretty high. So that negative helps us out. So while volatility looks like this, let's go to some real examples. This doesn't matter. Again, what stock is it? It doesn't matter. This stock, we could say, has a pretty defined range. Yes, it does break out. I'm not going to say that it never is going to break out of this range. I mean, we can go back to 2000 and everything broke out of the range. Or 2020 and everything broke out of the range. But what we try to do is draw those same lines. Yeah, you can draw them straighter than mine probably. But what we want to do is kind of get that tops, the bottoms, and then try and draw a little line of basically 50-50. Then we can tell that this is in that buy zone because it's near that low. Up here would be your sell zone. So when the volatility is touching that upper band, if whatever assumption you come up with, bullish, bearish, market neutral, for whatever underlying, you need to go here first. All right. I've got a bullish assumption in XYZ, and all of a sudden I go over here and look at this. Well, whatever my bullish assumption is in XYZ, I know I need to be buying those options. I could be buying calls. I could be buying a call spread. All right. All of those things for a bullish move. I would want to be paying for that opportunity, paying for the right. All right. Now, we could start drawing these lines. I encourage you guys, when you're looking at your underlines, find them on here. Okay. And then just take a look at it. Just send that line out to the left and check it out to see if it's actually still staying intact. Sometimes, I'll show you an example. We get an incremental move higher on an underlying. So now the support becomes, or the resistance becomes the support then. All right. Not usually do we see them really drop lower. It's, as of recently, it's kind of been an increment higher. But for the most part, we can look at just about any stock, put these lines in there, stretch it out for a couple of years, like this one, throw those lines in there, caught a couple of tops here, caught a couple bottoms, and then just shoot those lines to the left to see, shoot those lines to the left to see if it comes in. I added a little 50-50 line here, but you can see you draw that way out even well before the pandemic. It was still pretty in line. Yeah, we could say 2000 was a little bit lower, moved into this range, but we've stayed there for this underlying. Pandemic, of course, it broke out. Do I want to add that as my all-time high or the only time I sell? Well, you won't have it happen for another 10 years or something. So no, black swan events, we don't want to really add that to our data point. We don't want to forget about it because the next time we have a massive spike, that's probably where this underlying will go, is up to around 1 on this one. But in the meantime, yeah, we could break out a couple of times. I'm not going to let that influence my decision. As a matter of fact, I have this code that that will discount anything before 6 months. So I only go back 6 months and use that as my data points because I want what's going on right now for the last 6 months. But yes, you stretch that out, it's probably going to be very tight to where you are. Again, we could do another one. This one, I tried to hit as many tops as I could again, letting it break through on a few of them. Draw those lines out to the left. Again, you can see that they stay in line. Pandemic, that was a black swan event, right? Here, I would want to be selling options. Is it going to go lower for sure? No, we could see the last couple of times it broke out a little bit higher. I'm willing to take a little bit of heat myself. I have a higher risk tolerance than maybe some people. So I like to have a breakthrough. I'm not worried if it goes a couple of ticks against me. Yes, I know it hurts my position, but I know that more times than not, when it gets up to this level, we have that reversion back to around at least the median or revert back to the mean. All right. So we could see that or drop all the way back down to the bottom area. Again, this is one of those ones where we saw an incremental higher, and this was NVIDIA. NVIDIA is tied to Bitcoin, so of course volatility has increased for this underlying. If you ever want to trade Bitcoin, you might as well just go over to NVIDIA and you can trade that. It literally is a cheaper alternative and almost runs lockstep with that. Another example, drawing those tops. Like I said, I usually discount most everything from 6 months back. But again, good to have that data in there. Most scripts will go back 52 weeks as this chart does. But I've written the script so that it drops the last 6 months off of that. All right. Another chart here, drawing that line back a couple of years. You can see from here to drawing it back a couple of years, it stayed within line. Yeah, we had the pandemic, I'm not going to lie. But again, pretty in line, those pre-pandemic ranges to now, right? So while we've seen these fluctuations and volatility and these spikes, and most people are like, wow, we had that pandemic and volatility, blah, blah, blah. Well, yes, but we have come back to reality with regards to volatility. So we know that if we're looking at a particular underlying, we can look at this chart. I mean, folks, can you look at this chart? Are you believers in this? You look at this chart, can you tell that we are near a high here? Like, does this make sense that this is a sell zone for options and this is a buy zone? Because we know that when options see these volatility drops, the price is going down incrementally. So we start out, let's say, right in this area, we're starting out at 45. We drop down to, let's say this is 35. That's 10 percentage points in volatility. Okay. So if it drops 10 percentage points, that means it's 10 times that multiple for the volatility coefficient in the options montage. All right. Now, I don't want to scare you guys all away when I say option montage. That's just that page with all of the calls and puts and the different prices, right? The one that, before you started learning about options, looked like the inside of a cockpit or something. I was going to say, I couldn't think of what the operators, the old school operators, when they do all the punching of those things. All right. So volatility drives pricing. All right. So we know that if it increases by a percentage point, all the prices increase by that coefficient, right? Every strike has its own volatility coefficient. Volatility affects further duration options a lot more than it does the nearer duration options. Okay, so when we're looking at taking advantage of this on the expansion, we want to go out there further in time. All right, so this is the chart of what I was looking at for today, but I took this snapshot a couple of days ago, trying to play these Iron Condors, Iron Butterflies a little bit before, in case things go a little wacky, because these are the ones we can actually play around with a little bit, adjust our pricing to become more profitable, to increase your probabilities of success. All right. So I was looking at XOP, looking to settle down somewhere in and around this range. All right. I don't think it's going to go up too high or down too low. I think we've had a big spike. We're ready to settle down for just a little bit. Now I look at this, if I just look over here at this, I have a market neutral assumption. If you think I'm going to be buying, throw a B over in the chat window. If you think I'm going to be selling an option strategy, throw a C over there in the chat window, right? While I get my stuff to put together here. Because what I would look at for me is to draw a line in here, try and draw a straight line in there, and then try and draw a support line in there, right? And then I'm going to draw just kind of a 50-50 line. I know that when this hits here, how many times has it done it in the last year? I'll call that one. So 1, 2, 3, 4, it did it. Didn't do it there. So 4 times. Doesn't happen very often. So when it gets to that extreme, you want to take advantage of those premiums that are just pumped full of juicy premium, okay? All right, so let's make it simple. Talked a little bit about options. I'm going to drill down on them just a little bit here before we move on so that you guys are clear of concept. And I'm going to give you guys some little quips to help you remember these. Greeks. Yes, I said it. We're doing Greeks. Delta. All right. Doesn't matter what the stock is. XYZ. We're sticking with this underlying. Now, delta tells us a lot of different things. On the floor, we used to just say it's data. Delta's data because it gives us all kinds of probabilities of success, risk, everything, right? How much you need to hedge. That's one other thing I haven't mentioned in a lot of these videos. So for you guys that have stuck around for some of this, you might get something new. All right, so delta. Delta is the rate of change, okay? So when we're looking at a stock, let's just make it simple. We're at a stock that's $100, all right? So when we're buying and selling stocks, literally your probabilities of success are 50-50, whether you're buying or selling them, because the next tick could be against you or the next tick could be in your favor. So you never know if you got the high or you got the low. It's really beholden 50-50 probabilities the time on your timing of buying that you are going to be immediately profitable. All right. So delta on the ones that are at the monies. All right. So at the money options are the strike that is closest to where the underlying is trading. All right. So those options are usually a 50 delta, and we've got calls on one side, we've got puts on the other side. The calls are usually going to be like a positive 50 delta. It's 0.5, and the puts are going to be usually a negative 50 delta on those ones that are right at the money. Now, we've talked a little bit in the past videos about skew being one way or the other. That can help, but when we're just trying to isolate this, and generally speaking, the at the monies are really close to 50-50. So that's what we're going to go with today. And those at the monies are usually going to be, let's just make it simple, $2 at $2.50 on the calls. The puts we'll just say are the same again, $2 at $2.50 for those options that are at the money. So now we talk about delta increasing, right? It's on $1. Sorry, $1. It increases to $1. So we've got that dollar move. Dollar move. All right. So now we've got a dollar move higher. Delta goes into our premium. So on that dollar move higher here, our premiums would have jumped to $2.50 on the calls at $3 and dropped on the put side, right? Because we moved higher and our delta for the puts is negative. So now we would be at $1.50 and $2. Okay. So an increase, the puts are negative, a positive plus a negative makes it a negative to our position. Now, what happens when it goes to 102? Does anybody know? You can throw it over there in the chat window if you know. We got this other Greek that not many people talk about except for the guys that are like day trading and stuff like that. But gamma is a really important one. Gamma is the dollar number 2 one, right? Because gamma goes with delta. The easiest way to remember is gamma goes with delta on dollar number 2. So we've gone onto our second dollar. We're here. Gamma at the monies are usually around 5 cents. So we move higher by $1. Gamma goes with delta. Now that delta on the call side is 55 cents. So now we would increase by 55 cents. We're at $3.05 at $3.55 is what those premiums would do. All right. Just based on delta. Gamma goes with delta again. So that's negative 45 cents. So it would lose and go to 105 bid at 155 offer. Okay. So see how those levers and pulleys are working? You're moving higher. Gamma goes with delta there. Now, if we started moving lower, you would have to do the similar, but a negative plus a positive delta would make this a negative delta if we started going down. And if we move down by $1, right? We move down by $1, a negative plus a negative equals a positive. So it would add into it on a negative. Gamma would add into the delta for a negative move, right? Because a negative move plus a negative delta makes a positive plus the gamma, right? So gamma goes with delta. The other thing is, I kind of skipped over this a little bit. At inception, when we first do the trade, on the floor, or another delta data aspect is delta tells us the fluctuation, how it's going to affect our premiums, the rate of change, all right? And delta being data also tells us the probabilities. Now, delta is the probability of ending 1 penny in the money at expiration. At expiration, all right? So that's key, because a lot of folks out there will teach. I've seen folks teach, and they've said that it's just to go in the money, and that's not true. It is the probability of being 1 penny in the money at expiration. So that 50-50 one, it's got 50-50 chance of being 1 penny in the money. The ones that are deep in the money and are like an 80 delta, those have an 80% probability of ending in the money by 1 penny, right? So a lot of folks will talk about buying options deep in the money because you get that big delta gamma jack up, right? Listen, folks, you're also risking a lot of money by buying those in the money options. My thesis is to buy out of the money options. You have to pay less for it, right? Yeah, your delta is a little bit smaller, but if you actually compared apples to apples like I do in my videos, I show you why you would want to choose those out of the monies. All right. Risk less, more reward. All right. Is ultimately what that boils down to. So delta is the probability of being 1 penny in the money, but on the floor, we had another thing. We called it 2 times delta equals your probability of touch, meaning that the tough. Probability of touch, meaning the underlying comes up and trades our strike. So that 16 delta, let's just say for our example, XYZ's 120 strike is a 16 delta call, all right, out of the money. But 2 times the delta is 32% probability that during the life of this option, this underlying will trade, XYZ will trade 120. It's got a 16% probability of being 1 penny in the money at expiration, but it also has a 32% probability of seeing 120s trade, right? 20s trading just for a second. That's all it's saying is it goes up there. You see that 120 print on the board, you're beating the probabilities. So what my suggestion is, that's when you would cover those covered calls. You've gotten the increment, you've beaten the probabilities on a covered call strategy like that. So 2 times the delta, probability of touch, out of the monies. Keep that in mind when you're trading. It'll help you keep your powder dry if you know those probabilities, folks. And then we've got Theta. He's the thief. It's Theta. I'm having trouble spelling today. Theta. So Theta is the thief in the night that comes and steals your premium. And he comes every single night, never missing a beat, all right? Further out in time, doesn't really know you're alive. Right now, close to expiration, maybe Friday's expiration, that dude is grabbing fistfuls because he only knows he's got one more night to take all your money, all right? So tonight being the last night of those options expiring tomorrow, the guy is grabbing fistfuls. Might be probably the weeklies or inside of 7 days. It's really getting aggressive. And it's not like linear. He's not taking a penny. It's taking a penny, 0.1, penny, 0.2, 2 pennies. All right. So he ramps it up, but it's really slow at first. It's always there, but then it starts picking up and then really dropping off. And probably not even a good representation of the drop off here at like 7 days to expiration. It falls off a falls off a cliff. And we really see the ramp up starting to happen around 35 days to expiration, days to expiration. And I say basically your line in the sand is 45 days to expiration. So this is the zone. This is the sweet spot. 35 days is really where it happens. But I would say this is your buy zone. Or why do I do that? Why did I do that? That is not your buy zone, folks. Do not do that. This is your sell zone. Why? Because you want to sell premiums when they're extremely high, right? We can see that if this was the price, we would want to sell here. Sell here because then the premiums go down, right? This is your buy zone. It's basically 70 days to expiration and out. All right. That's your thief. And then volatility, we've talked a little bit about that. That's Vega. Vega is just implied volatility, folks. Just a fancy name for it. Not a lot of people have told you. If you guys learned something new, throw a Y over there. Vega is implied volatility. All right. It's not VIX. It's not just volatility. It's specifically implied volatility. It's just got a fancy name for it. So when you're looking at the Vega coefficient and the volatility number right next to it, well, you know that that volatility number is the same thing we just saw over the charts. Except in the charts, it's giving you a decimal of, say, 35. And in here, in the options, it says 35%. All right. It's just turned around. When is earnings? Will that cause IV to run up and then crush? That is a great example or a great question, Zeke. This particular one that I'm looking at doesn't have earnings in it. It's an ETF. Like Target, that's, remember, if you watched last week, I did Target a little bit nearer duration, and that was because of the earnings. You're right. We will see generally volatility spike heading into earnings because it's an unknown. All right. Just like volatility affects further duration options more than nearer duration options because that's more unknown than the here and now. So earnings, we see volatility spiking because we don't know what's going to happen. We don't know if they're going to have good earnings or not. We, it may have our assumptions, but we don't know. As soon as those earnings come out, volatility plummets because everybody knows all the information now. There's no unknown. So yes, after earnings, we will see the volatility crush happen. I suggest if you are long options heading into an earnings, if you're right or wrong, if you're really wrong, then and those options are worth nothing, then it doesn't hurt to take it into the earnings. But if you are up money on a long call or a long put heading into that earnings, I would pull the ripcord on it because you could be up money heading into that earnings. It could continue in your favor and the volatility crush will take all of your money away, right? Because it could drop 20, 30 percentage points in a day. And we've seen that happen. Have you ever noticed a best IV range to use an Iron Condor, i.e. 14 IV may not provide as much income potential? Great question, Ron. But if the IV is, say, 14, implied volatility is 14 right now. Let me just erase everything on this page. Let's just say, you got your thing over here and it says implied volatility is 14 right now. That doesn't tell me anything, right? Because if it's Tesla, then it never gets down that low. But, it could be high for a utility. And yes, your premiums are probably not going to be, like a $50 utility that has an IB percent of 14 or an IB of implied volatility of 14. That utility will never see the premiums that, let's say, a $50 tech stock would see, because a $50 tech stock will probably never get as low as 14. It might get as low as, say, 20, right? So on a tech stock, 50 might be the high, 14 might be the low. So, and they're both $50 stocks, right? So all I can say is yeah, premiums up here are going to be bigger for the same at the money strikes as the utility, but the utility's implied volatility is so high for itself that I know that they are expensive. So this one is definitely a sell zone, right? Whereas over here, no, you can't compare. I can't compare ABC to XYZ, all right? Because they have their different coefficients, okay? So make sure when you're trading it, yeah, ABC, you might be looking at it and saying it's only got an implied volatility of 14. It's not going to make a whole lot of money by selling that option strategy. But you also know that those premiums are the most expensive they've seen, and they're likely to come off with volatility coming out, right? Yes, it could go higher, but the probability, the likelihood of that is very rare. We've showed that time and time again with the real life examples. You guys could throw examples over there in the chat window throughout all this, and I could show you that the volatility right now is likely, without even knowing, the same out in time. As a matter of fact, I haven't done that with today's, so we could do that as well. All right, so real life examples on this one. Getting into my example, XOP, listen, folks, this is my market neutral stance. I wouldn't necessarily suggest that you follow on with this because it's my assumption, only if you have the same assumption. But mine is market neutral. Now, I said outside of 45 days and in is where we would want to be selling options. We already know based on the chart that this volatility is very high. So if I go back and look at our chart again of XOP, we can see that if I erase, I'm going to erase all this ink again. We can see that when implied volatility gets up here, it's really high, and that's 62, 63-ish, right? So when XOP gets up to 62, 63, maybe even 65, that 65 area is an extreme high level. We know those premiums are very expensive. Now, coming back to the low, we know that the low is around 40 or maybe even say 45. So somewhere between 65 and 45, I know my range. It's if XOP is down there at 45, I know they're cheap, but right now I know they're super expensive. Its implied volatility coefficient is 0.6297, or you could round it up to 63. If it's over in the option montage page, it's going to have close to that 62, 63 number, right, on these at the monies. It's not always exactly down to the nets, but very close, you can see. It is that coefficient for the at the monies, which are usually those ones that are, or the spot month, which is 35 days to expiration. That's where the most volume and open interest is at any given time on any options, that 35 days to expiration, right? Further out in time, you're going to have less volume in there, or trading going on. So when we're looking at this, we're looking at that 62. You can see that tells me when it's up around 62, 63, we know we're at extremes. We know that this Vega coefficient is in there, full tilt, right? If it was down around 35, you could say that, let's just say it dropped 30 percentage points like Zeke was asking about with earnings. It could drop 30 percentage points. We see that volatility crush. Well, 30 times the Vega coefficient associated to those strikes, that becomes pretty steep very quickly. We know we're talking $4.50 coming out of just this strike, right? Comes down 30 points, 30 times 15. That gives me $4.50, right? So just that premium drop, the market could drop. I could see this market drop a couple of dollars, but with that volatility drop, I'm going to lose money. All right. So let's go into this a little bit more detail. Got off on a bit of a tangent there. So delta tells us the probabilities. The at the monies are usually the ones that are going to be close to that 50 delta. 115 is as close to, or is one of the closer ones. It's actually skewed a little bit because that's the at the monies, those 114s. So we come up here, these 115s are going to be close to the 50 delta, right? I'm not trying to make those negatives. That's a positive. But you can see that they're very close to that 50 delta on those 115s. Now, we go further out in time, delta at the monies, those are going to be right around 50. But you'll notice that the further you get away from those at the monies, the deltas go down quicker up here, closer to expiration. You can see further out, probabilities are there because you have a lot more time and there's a bigger probability of fluctuations throughout all of that. All right. So delta on the increase, this goes from 114, right, to 115.11 or whatever, or the last trade is 115.31, however you want to look at it. Then that $1 increase, these premiums all go into the calls. Over here, the delta is negative. So on a dollar move higher, these premiums come out. And we have a guest speaker, a dog with a plush toy, because they know how to open doors. So delta, and then gamma goes with delta on dollar number 2. So you would see the gamma go into those premiums there on that second dollar move, moving up to 116.11-ish, right? Gamma goes with delta. Theta, notice it's always negative because you can't go back in time, all right? So theta is always going to be eroding those premiums. Sometimes you can take advantage of it. Sometimes you want to limit it. Theta, like I said, is more aggressive, closer to expiration. We can go way out here in time and look what happens with the theta going from 100 days, 60 days coming in. It only increased by 1 penny, right? Now you come in 30 days, we can see that the premiums or the theta coefficient increased by 2 cents, right? In 30 days, it went up by 2 cents. Now, that's why I'm saying outside that 45 days to expiration, because you want to get in this type of scenario where theta isn't really ramping up really quickly. Again, 30 days in, or basically 30 days coming in close. We can see it only increased by another 2 pennies over that 30 days, only increased by 2 pennies, right? So, over this entire 60 plus days, it only increased by 4 cents over that entire 60 days. But then we go for these next 35 days, what happens? 2.5 times it increased, all right? Increased from 10 to 25 in less than 30, or in right around 30 days. So you can see that you would want to take advantage of here as your sell zone. And out here is where we're looking to buy, okay? Because theta isn't very aggressive out here. And again, Vega, you can see it's always positive because as volatility increases, all of the premiums increase. And you can see that Vega is more aggressive further out in time in all of these. And it's kind of almost non-existent up here. Okay, so another reason why we want to buy further out, we want to limit our theta decay by buying further out in time, be good stewards of your capital. Volatility affects the further duration options more. So when volatility spikes, we can take advantage of it, right? Sell zones where we take advantage of theta. Like at least we know we've got that consistent thief like taking money out. So at least that's helping us every single night. And in order to have him really help us out, we need to be inside of 45 days to expiration. Like I said, the sweet spot is 35 days to expiration. Because then we get that real massive theta increase. Volatility during that time starts coming out. Then that's like the feather in our cap, all right? That's just an add-on benefit as this premium starts dropping precipitously at that point, right? Take advantage of volatility expanding further duration. You're limiting theta decay. You're getting those two things on your side. When you have high volatility, get those guys on your side. Sell volatility, sell Vega, all that comes out. You will see these strategies turn around very quickly. You're not going to be stuck in them forever. All right. So with this build out, what do we want to do? We want to look, first place I look for is right around the 20-ish to 25 delta. All right. That's usually where I start building the strategy out and define that risk somewhere at around the 85 delta. Now, or sorry, the 16 delta, the opposite of the 85 delta. So we want to try and define that. The reason why is because we have a low probability of being in the money at expiration, 25 to 20% probability of being 1 penny in the money at expiration, or there is that 40% or 40 to 50% that we're going to get tested. Still pretty good odds that we're not going to finish in the money and that we're only just getting tested, right? So that's why we want to play it that way. And with that, so I go in here looking at the options. We are trading XOP right at around 114. I go to the puts here. Let's just start out with the puts. And I'm looking at the 95 strike. That's right around that 20-ish to 25 delta, right? You're going to have to play around with this just a little bit. I'm getting you a starting point, started around that 20, 25 delta. And then, you want to try and go further out if you can. But sell the put, define that risk by buying it, about 10 ticks out. If it's a $100 stock, we're looking at 10 ticks. Anything less than $100 stock, it's probably right around a 50 or right below $100. You're probably going $5 wide, $5 to the $50. Anything below $50, you're looking at $3 wide. All right. So from 0 to 50, try and get it at $3 wide. 50 to 100, you want $5 wide. 100 to 200, you want $10 wide. 200, $20 wide. Right, 10%. So is your basic rule there. So selling the options at the 95 strike, right around that 18 delta, defining the risk, right? Same thing on the flip side. I want to go equal distance then away from that. I went basically $20 down. I want to go $20 higher. So I go to the 35 strike. And where is it? 35. I want to sell that one. It's right around that 20 delta again. Define that risk at the 145s, $10 wider from there. All right. Now, here's where we come down to it. I've already mentioned strike location, right? Somewhere between the 20 and the 25 delta is where we want to start selling for this option, Iron Condor. If it's less than $50 wide, we're looking at defining the risk $3, 50 to 100, $5. And in this case, I'm at $100 stock, somewhere between $100 and $2. I went with $10. All right. So that's your first breakdown. Go to that 20-ish delta. Next thing we're doing, define it. Finally, what we need to have happen is collect. Let me write this down for you. I want you guys to get a credit. Your credit, all right, the credit is equal to 25 to 30% the width of the spread. So, right, we've got $10 wide here. It's a $10 wide spread. And I'm collecting $2.80. All right, so that's 28% the width in this strategy. So $2.80 on those ones that are 45 days to expiration. All right, pretty hard to do this really close. I did it with the Iron Butterfly. I did it on the nearer duration option, but remember, I had like 15 or 20 days to expiration at that time, and these were outside of 45 days. So it was like I rolled into the nearer duration. That's why last week on the Iron Butterfly, I was using the July, and now I'm using the August, all right? Because the August is just coming into that 45 days. And again, I did this a couple of days ago, or actually maybe even yesterday. All right, so defining that risk. We could take a look at XOP with different strike locations here. This one, I got a little bit more aggressive, went into that 25 delta, right? Close to that 25 delta, selling the 100s. So I'm basically selling the 100 puts now, sold the 100s, buying the 90s there. Down here, equal distance array, to the 130s. So I went to sell those and then buy the 140s. All right. Now you can see I got a little bit more aggressive, a little bit tighter, a little bit lower probabilities of success. Right before I had that 18 delta, and now I'm looking at the 24. Excuse me. So closer to a 50% probability that I'm going to get tested here. All right. And with that said, I even got better than that 33%, the width of the spread, 25 to 33 or third the width of the spread. So did a little bit better, getting a little bit more aggressive. Now, this is where you guys need to, do some little internal thinking here. How risk adverse are you, or how much of a risk appetite do you have? For me, I would probably go with the ones that is just a little bit further out, to be honest, and I have a high risk tolerance. So I'd rather just collect the $2 rather than the $3.80. I'm going to look to get out though as an exit, and I haven't talked about this. Same with the Iron Butterfly. I did with the Iron Butterfly 25%, but with this one, I'm looking at getting out at 50% of max profit. All right. Now, when you're dealing with those stocks that are below 50 and you're doing this spread, you're basically doing $1 wides or whatever. You're only collecting 30 cents. Well, 50% of your max profit isn't going to cover your cost probably. So that one, you're probably going to need to take it off for a nickel or a dime on those ones that are below $50. So with these, I try and stay a little bit higher than that. Get to about that $5 wide, $5 to $10 wide condors. All right. So $3.80 on this one. Now, if we go over to the Analyze tab, we can see what it looks like. We did it with the August and the $3.80, a little bit better risk reward, but you can still see that my area of profit is outside of one standard deviation move, basically, because what we need to do is take that strike, okay, the strike that we sold, and I was talking about that 25 delta strike, right? These were those, or about the 25 delta strikes there to collect $3.80. Now, my break even is determined by, the short strike, the 100 puts, which is right here. Let's go over here, the 100 puts, right? Now, the break even is over here, but this is the 100 put. Break even is here because I got $3.81 to give me that wiggle room to here, which ends up being right around that 16 delta, right? 16-ish delta. Same thing goes here. On the upside, I'm looking at the 130s, lining up quite nicely there, but $3.80 to this side gives my break even a little bit higher. It's going to be 133.81 because I sold those. Now, why does my credit go to both sides? Well, because we can't go in both directions at one time. So it's either going to go one direction or the other, and it might even stay right here. But the idea is my credit, if it will help me to the downside or the upside, depending on which direction we're moving. That credit will help to both sides. All right. And I know a lot of you guys are asking, would I ever leg out? In this case, I would. On the Iron Condor and the Iron Butterfly, I would, because if the market moves in a massive direction, one way or the other, I can cover one side of that strategy. So for instance, let's just pull up the platform here. Did I get it? Yeah. All right. So we got the platform here. XOP, a couple of days later. What's volatility doing? It's starting to come out. So we know that that's helping me out right away. What was that strategy? It was $3.81. I've got it right here. Is it? Oh, that's Target. I've got Target ready for you guys. XOP. Let's do XOP real quick. We were in the August. Just take a look at this as we had it set up before. I was doing the 115. So I'm going to do this as an opposite order, and I'm going to buy the 115s, sell. Oh, wait, that's this. What did I do? The 100s. I'm buying the 100s, selling the 90s. I think those were my strikes. To the upside was the 30s. I'm going to buy those and sell the 40s because I'm doing this opposite to get out of it. $3.71. So basically from yesterday to today, this strategy has increased in value by 10 cents. Because if I were to buy it back 380 to 371, you can see that that's basically a profit. Now, we could go through all the math here and determine how volatility, everything else affected this. But to me, it looks like if I'm losing 13 cents, 7 cents, that's a 5 cent difference, right? If this downticked by 1 percentage point over in the charts, tools, I don't want tools, from basically 60 to 61. So that's 2 percentage points. So market did move higher, would hurt one side, but help the other. But we got 2 percentage point decrease here. Okay, so that would mean then over on the call side, we've gone from a Vega of 15 to 11, so another 4 cents. So it's like 9 cents for every 1 percentage point downtick will help me in my options, right? Because I'll talk you guys through this real quick. If I'm looking at the volatility coefficient for the 100 puts, right? If volatility downticks, like we were talking about, 1 percentage point, these 100 puts are going to decrease in value by 11 cents by that 1 percentage point. The 90s it's going to hurt me, right? Because I bought those. So that 7 cents will hurt me on my buy side. But the difference from the help versus the hurt is 5 cents, right? Same thing over here on the put or the call side. Call side is 15 cents. The short puts are 15 cents. The long put. All right, wake up. Calls. The short calls are 15 cents for Vega. The calls on the short calls is 11 cents. So that's 4 cents. Total of 9 cents will help me with this volatility going down. Now the underlying did move higher by $6, but keep in mind, same thing is going to happen with the delta. It's going to help me on one side. It's going to hurt me on the other, right? If we're moving higher, the short call spread here, which is all we're talking about, like with this strategy, is this short call spread, right? We're just looking at the short put with the long put, and we're basically just adding. Wait, what just happened? Everything's going wrong. Short put. Why is that? I think I've never traded before. All right. So with that said, you're basically got a short call spread. Short put spread is down here, $15. There's your short put spread. Okay. So add it all together. You've got your Iron Condor, third the width of the spread. Okay. What else was I going to talk about that? So Vega going down. Theta is obviously going to help me because you can see that the theta is bigger, closer to the at the monies, and less the further away. So all of those things were short, closer to the at the monies. All these levers and pulleys will be working in our favor if we get the directionality right. Right? So that's how we would do it. How would I leg out? Let's look at it this way. If we had started out at the monies, and let's just try and compare apples to apples here a little bit. Well, let's go with these. These are closer to the at the money right now. So I'm going to sell. Look at these two right here. We're looking at the at the monies. And if I were to do this today, right, I would probably go $15 lower. And that's where I'm going to start defining my risk. Right? That's what I would do. And then move to the upside. I did so 15 higher. We're looking at the 35s now. Sell the 35s, buy the 45s. Okay. For that strategy. Now, what happens? We would start it out like that, building it out. I don't know why nothing's working in my favor today. It's an uphill battle. All right. But now the market moves. All right. You set it up. Now the market moves completely the other way. Let's just say this underlying rallies really hard. And now we're looking at something like the, what did I have? $10 wide. So All right. Okay. Too many. I get it. Do this. Sell that one. We are looking at $15. So 45 would have been the at the money is 45. So 60s. Actually, this sold off. What did I just do there? All right. So if we had started out when it was at, kind of got my head, I wasn't planning on doing this, obviously. 45. So if we had done this strategy at the beginning when it was trading right here at around 45, okay, and the market really sold off, now our puts are deep in the money. So with that said, I was looking at the strategy that would have been selling those, buying those, right? So did I do $20 wide? We would have been around $45 or 145, we said. So the 60s would have been $15 higher than that. That's where we would have sold and then bought to define the risk at the 70s. So that's where our strategy would look like had we set it up when the underlying was trading right here at 145. Does that make sense to everybody? Because I know this is a little bit of a different concept that we talked about last week. I'm getting a little bit deeper in the weeds. So if this is making sense, throw a Y over there. If it's not making sense, throw an N over there so that I know. So basically looking at the 145s, sorry. And let's just say during the time I put this trade on, it was trading 145. So I went $15 lower to do my Iron Condor, $15 higher to do that Iron Condor, same thing. But now it's deep in the money. So this call spread that I have, right? That short call spread that originally was probably worth, several dollars is now only worth, if I were to get out of it, buy that one and sell the put or sell the 170 call, it's only worth 20 cents to buy it back, right? Now, why buy it back? It increases your risk, all right? If I'm buying this out because I'm paying something, my overall credit that I originally got, that 380, right, is now really only 360 because I got to pay 20 cents to get out of one leg, all right? So my total collection now is only 360 if I buy out of this spread. Now, the put spread is basically a full loser, right? Because I'm long here and short here. That's almost a full loser there. Well, not quite, but it's close. So it doesn't help me anymore to have that call spread on. I might as well take it off and expect that we're going to get a nice big rally and my put spread will go out of the money, okay, and expire worthless. That's the real way to leg out of this. As soon as you see that call spread is kind of like worth nothing, in this case, where the market sold off, my put spread, my short put spread's kind of yucky, but my call spread's zero. I made money on that. I might as well take it off because if tomorrow something happened and XOP blasted off through the upside and I didn't take off that call spread, now my put spread is worth nothing and my call spread is jacked up, right? So that's the only, these are really one of the few strategies that I will leg in or leg out of. I won't leg into them, but I'll leg out of them. If the directionality has blown off to one side, that's the other side is what I'm going to take off, right? I'll pay about a 20 cent, 30 cent, something to get out of it. Yes, I did increase my risk because I had to pay a debit, right? But that risk, actually, in my eyes, is more risky to hold on to it than to take it off because it could cost me money. It's not going to make me much more money. It's only 20 cents now, all right? So I'll likely take that off to leg out of that strategy. Does that make sense for everybody? Throw a Y over there if it does. Throw a Y over there and I'll throw you guys something back. All right, I got an offer for you. It is going to basically be the last week we are offering this. It is our full course. You get instant access to over 15 hours of content. So if you guys have been thinking about, maybe I'll do it. I'll watch a couple more videos. This could be your last opportunity to take advantage of this. This is the one that's really key right now, is the interest rate one, as far as I'm concerned. Protect against rising interest rates. If any of you guys have watched what's happened to your bond portfolios from last year to this year, it does not look good, because the interest rates, like I talked about, the teeter-totter, as those bond prices, or as interest rates go up. I mean, the Fed's jacking interest rates right now. They're raising the short-term interest rate. Well, that means bond prices are going down. Your portfolio is reflective of price. All right. So it is getting hurt. I show you how to lower that, how to trade with that market profile. And basically, you're getting all kinds of different videos. You can, when you watch them, basically, it does. It gives you a check mark and says, hey, you've watched this video. It doesn't mean you can't watch it again. It just means that it's trying to help you out. Hey, you've watched this video. Do you really want to watch it again? And one thing I say when you're taking advantage of this, there's all kinds of other videos that I've done on like the Iron Condor, but I approach it from different angles, if you will. I try and drill down on this one. We're talking about volatility and how that's going to affect our premiums. In other ones, I talk about different aspects a little bit more. So, you know, you can watch a different video and get some of the same content. But like I said, you know, Ron, I see Ron's back again. That guy drove our skew commentary for a couple of weeks now, right? So guys, please comment, throw that stuff over there. You put it in my head. I know that Ron was talking about skew. I'm like, hey, next time I talk, Ron's there. We're going to be having a perfect example for him. All right. So please take advantage of that. One thing I don't think I did was go back to this strategy. Let's talk about this. This is your bonus hour, if you will. So when we were looking at this strategy, the underlying was trading. Where was it trading? Right around 149.50. So about as close to the 150s as I could get. This is based on the straddle, right? The iron butterfly is the straddle with defined risk on the wings. So we have our straddle. Max profit is if the underlying ended up right there at 150 at the end of the day, or at the end of our option expiration. We got a nice credit, break evens. We talked about all that. Now let's go back to our platform here and just look at target. I'll go to the charts. Let's look at target. See what it's done differently now. When we were looking at target before, let's just, I'm trying to find the chart. So we were just a little bit higher. It did press down. I'm not looking at target. I'm looking at XOP. I literally feel like I got a lobotomy today, folks. We're going to get through this, right? We're going to get through this type of why. Anyway, so XOP. XOP did get a little bit of a bounce away from this 100 area. So when we were looking at this strategy, I think it was right around 115 when I started looking at it, picking those 115 strikes. Actually, it was 114, right? So we're a little bit higher, had a little bit of a bounce, tested the point of control, bounced a little bit, still looking at that strategy. We could go over to this page and take a look at it from XOPs. I was looking at this with the 15, but look, we're in the August. So I did this in the July on that example, because I didn't want to have, or actually this, get myself confused. This was target. We did do, this is the refresher on target. Target, because it has an earnings in that next month for the iron butterfly, I did the straddle. So the straddle was the 150s. So these are right at around 50-50. Those are the ones I'm going to buy these to show you how to get out of it. So buying both of those, we had the defined risk $10 wide. So sold those, sell those to get out. 50s to the 60s. I got to sell those to get out too. So $5.29. We talked about this and it was $6.81. What was target? 6 something. Just rip through all this stuff. All right, $6.64. So it's gained $1 during that 1 week. All right, and that $1 gain isn't due to volatility because I got that wrong. It broke through a little bit more, but that theta component, grabbing fistfuls of cash every single night, is what's helping this strategy out. So sometimes we don't always get everything right. This one, I obviously picked the wrong timing exactly on selling options premium, but I know that it's at a level of resistance. It's likely to start coming back off, or at least tempering itself at these levels, because we can see that it is extreme. And if I draw these lines back, we can see that the week chart, we can see that it is in line with that. As a matter of fact, it hasn't broken out like that in a couple of years. So it is a big anomaly. I'll be taking advantage of that all day long. So volatility isn't working in my favor right now, but the theta component is absolutely helping me out, because we have had some market movement. We're right back about where we were talking about this a week ago. And this is basically telling us theta is working in our favor. All right. So while we don't always get everything right, we try and turn the tables in our favor, catch those extremes. Sometimes some of the levers and pulleys don't work in our favor, but that's why we set all of this up the way we do, is because now, while Vega is not helping me, theta is going to town. All right. And like I said, we're getting ready to get into that 7 days to expiration. That's where theta really starts ramping up, and we can take advantage of that. All right. So the only thing you can take advantage of now, folks, is this offer. Like I said, it's over there in the chat window. I appreciate you guys all sticking around today, this evening, and hope you guys can take advantage of something like the Iron Condor, which is a great entry-level option strategy for selling premium. It's low probability of it going against you, high probability of success, defined risk strategy, so you know what you're getting into right away. All right? That's all I got for you guys. Make sure you guys subscribe, like button, hit the bell next to it, because the bell lets you guys know when I come in unannounced. I do morning videos called Spotting the Trade, where I talk about geopolitical stuff, the economic data, and trades we can do. All right? So if you can't take that, take it easy.